In this video, we're going to discuss the disclosures that companies need to make when it comes to segment reporting. The big three are revenue, profit, and assets of each operating segment. We've got information here for Walmart from their 10K, and they've got three operating segments. They've got Walmart US, Walmart International, and Sam's Club. And we see our big three right here. We've got sales, and then we've got profit, and then we've got assets. With sales, if the company, so let's take Walmart US, if a lot of their revenues are being made not just to customers, but also they're making sales to other segments, like for example, Walmart US is selling products to Sam's Club, then the company would need to disclose that and say, well, look, 62% of Walmart US's revenues are from external customers, but the rest is from selling to other segments within the firm. That's not the case with Walmart. They're making all their sales to external customers, so they didn't make that disclosure. Now, when it comes to profit, we see here that Walmart has got operating income, okay? Operating income, aka operating profit. You know what that is from financial accounting. They do mention in their disclosures, they say when they're talking about how the operating income was calculated, they say it includes certain corporate overhead allocations. What does that mean? It means there are certain things, like for example, the CEO's salary. Okay, the CEO of Walmart as a whole, maybe they say, okay, a third of that salary should be expensed to Walmart US, a third to Walmart International, a third to Sam's Club. That's just a hypothetical, but it gives you an example of how you would take a corporate level cost and you just allocate it among the different segments. So we don't know exactly what costs were allocated to each of these segments. They're just telling us, hey, when we calculated operating profit, we allocated some expenses to each of these segments. They did not, however, allocate every single corporate level expense to each of these segments. And how do I know that? Because companies are always required to provide a reconciliation to the consolidated numbers. Remember, the consolidated numbers are the entire entity, all of Walmart as a whole from the income statement. And we've got that column here. Here's the consolidated figures. And we see that when we say, okay, let's take the net sales of each of the segments and we add it up, it adds up to the consolidated total. However, when we look at the profit of each of the segments and we add it up, it does not add up to the consolidated operating profit. Why? Well, we've got this negative number here. We've got this 1.832 billion negative. That means that there are clearly some corporate level expenses which were not allocated to these three operating segments. And that's why if you add their operating profits together, it does not add up to the consolidated operating profit. And so we need this reconciliation. This column here, this corporate and support, that is not a separate operating segment. That is just saying these are corporate items that did not go out to, they didn't get charged to any of these operating segments. And so we need this column to reconcile these results to the consolidated results. Okay, so now with this operating income, you know, doesn't include things like income tax expense. Okay. However, if you are looking at another company, forget about Walmart, let's say you're looking at another company, they could say instead of operating income, they could say we use as our measure of profit EBITDA. Or maybe they use earnings before taxes. Or maybe they do charge some taxes to each of these segments. How do we decide what is the profit that is going to be disclosed for each segment? What we do is we look and say, okay, what is the chief operating decision maker? Which it could, the chief operating decision maker, that's a whole other issue, but it could be the company's CEO, it could be the COO, it could be a group of people, but let's just make it simple. Let's just say it's the CEO. So if the CEO, when they are evaluating the performance of Walmart US, Walmart International, Sam's Club, we say, what profit figure do they look at? And then they said, okay, is operating profit. Operating profit with some adjustments for corporate level allocations that have gone out to the segments. Okay, that's what's going to be disclosed here. But if it instead was earnings before taxes, then the company would have to disclose that. So you disclose whatever profit figure the chief operating decision maker of the company evaluates when they're evaluating the performance of these divisions. Now, also note the following. There is no cash flow data here. We do not see operating cash flow anywhere. And wouldn't that be helpful to know? So, even though they don't force companies to disclose operating cash flow, companies have to disclose depreciation and amortization expense that is allocated to each segment. Why do they do that? Because if you, as a user of the financial statement, say, hey, I think it would be helpful to know, to have some approximation of what the actual cash flow is. I see I've got operating profit here. I got the operating profit for Sam's Club, a little over 1.5 billion, but I'd like to know, what is the cash flow? Well, you could add back the depreciation and amortization expense, because obviously that's a non-cash charge. And so that's why companies will disclose depreciation and amortization. It's just an extra thing there to be a little helpful for you. Now, in addition to having assets, which again could be used to calculate ROA or return on investment for each of the segments, also they would typically have the CapEx, the capital expenditures for each segment. Now, if, for example, you had a scenario where there was one customer, so Walmart has over $510 billion of consolidated revenue, right? So if there was one customer that accounted for at least 10%, so 10% or more of that $510 billion in revenue, then the company would have to make an additional disclosure. They would have to say, okay, there's this customer that accounts for, let's say, 12% of our consolidated revenues, and that customer is a customer of Walmart US. Okay, so they'd have to disclose there's this major customer and so forth. So those are the main disclosures that a company would have to make when they're doing their segment reporting.